This is Japanese Economic Review Channel.
Hey there. So glad to be here to dig into all this with you today.
We are diving straight into the official statistics today. We're looking exclusively at the Japan Weekly Outlook published for the week of June 22nd to June 26th, 2026.
Right, and just the raw data. No social media noise, no market sentiment rumor.
Exactly. Our objective here is to bypass all that noise and just look at the raw structural mechanics dictating the market right now. And, the headline number we are dealing with is nothing short of historic.
Yeah, historic's probably the only word for it.
The Nikkei 225 has completely shattered the 70,000 mark. But, beneath that explosive headline-grabbing milestone, the official data reveals an internal architecture that is incredibly strained.
Very strange. It's actually a bit nerve-wracking when you look under the hood.
Right. We are looking at a market suspended on a very precarious tightrope. It's balancing extreme targeted momentum in AI against, well, a looming barrage of structural sell-offs, hawkish macro policies, and serious currency intervention fears.
Yeah, the internal mechanics of this rally are honestly far more fascinating than the headline number itself. The 70,000 level is a massive psychological victory, obviously.
Huge. But what does the data actually say about how we got there?
Well, the structural data from the Outlook shows a market characterized by just intense concentration. The sheer velocity of the move, combined with the incredibly narrow leadership driving it, it creates a very top-heavy dynamic.
So it's not a broad market win.
Not at all. The broader index is being pulled upward by a very specific gravitational force, which, fundamentally alters how the market will react to the upcoming supply and demand shocks we are about to see.
I want to look directly at the math behind that velocity because the numbers in the report are just staggering. The Nikkei 225 hit 71,250.06.
Right, which is an expansion of over 5,230 points from the previous week alone.
Just in 1 week. And the TEPBX is sitting at 4,044.96. But the timeline is what really demands scrutiny for you watching at home.
Yeah, the speed is the real story here.
Exactly. We went from the 60,000 level in late April to over 70,000 in roughly 1.5 months. It forces a real question about the underlying foundation.
It really does. It's almost unnatural.
It's like watching a sports car go from 0 to 60, but then it instantly goes from 60 to 120 without even shifting gears. When you see an index jump 10,000 points in 6 weeks, you have to wonder, is this unprecedented speed purely a reflection of actual growth? Or is it just pure momentum?
It's a great question. And the data points very clearly to a self-feeding loop. Specifically, we're looking within the semiconductor and artificial intelligence sectors.
So it really is just the AI hype carrying the team.
Pretty much. The undeniable anchor of this entire movement, according to the official statistics, is Kioxia Holdings, ticker 285A.
Wow, yeah, 285A has been everywhere.
It has. The stock just crossed the 100,000 yen threshold. That represents a roughly tenfold increase in value since the end of last year.
Tenfold? That's just wild for a company of that size.
It is. And because of that aggressive multiple expansion, Kioxia has actually become the largest company in Japan by market capitalization.
A tenfold increase for a company of that scale fundamentally rewrites the index. And I think this brings up a crucial mechanical point about how market cap-weighted indices function.
Oh, absolutely. The passive flows are massive here.
Right. It isn't just a matter of investors liking Kioxia. It's a matter of passive capital being literally forced into it.
Exactly. As Kioxia's market cap explodes, every passive index fund, every ETF tracking the Nikkei or TOPX is algorithmically required to buy more of it to match its new, heavier weighting.
It acts like a black hole, pulling in capital simply because it has gotten larger. It becomes completely detached from traditional valuation metrics.
That passive algorithmic buying is exactly what is absorbing the short-term overheating the Outlook highlights.
Because usually you'd see a pullback, right?
Right. In a normal traditional market cycle, a 10x run over 6 months triggers aggressive profit-taking. Institutional managers would naturally rebalance to lock in those massive gains.
But that's not what's happening.
No, the data shows that any institutional selling is immediately swallowed by a massive wall of new aggressive buying.
So people are just buying the top.
Yes. The conviction surrounding the AI paradigm shift is so absolute that market participants are treating record high valuations as entry points.
That is genuinely terrifying.
It is. The market is digesting its own extreme multiples in real time. And it's all driven by this relentless inflow of capital, specifically targeting 285A and its immediate peers.
But, that gravitational pull has to have a dark side for the rest of the market.
Oh, it absolutely does. It's a zero-sum game in many ways.
Right. If institutional capital and retail flows are all being sucked into Kioxia and a handful of semiconductor names, that liquidity has to be drained from somewhere else.
Exactly. The outlook data indicates that the capital fueling these star players is actually being generated by actively liquidating non-AI related positions.
It sounds like a basketball team where one superstar is scoring all the points and management is basically selling off the rest of the roster just to pay that one player's salary. Does the data actually support that feeling of imbalance?
That is a perfect analogy. And yes, the statistics explicitly map out that exact capital drain.
Hmm.
Institutional managers have mandates, right?
Right. They have specific exposure targets.
Exactly. And to increase their exposure to the AI sector at these stretched valuations, they are systematically selling off their holdings in traditional sectors.
Wow. So the old guard is paying for the new guard.
Basically, this creates immense upside resistance for the broader Japanese market. You have an index where a single sector is pulling the entire average upward, while the vast majority of the constituent companies are facing steady structural selling pressure just to fund the AI trade.
Which sets up a very fragile equilibrium. If the entire 70,000-point structure relies on the uninterrupted inflow of capital into a single sector, any mechanical disruption to that flow becomes a massive systemic risk.
That's the tightrope we mentioned earlier.
And the outlook outlines two major supply-demand events on the immediate horizon that could snap that rope. The first is the U.S. pension fund rebalancing at the end of June.
Right, the end-of-quarter rebalance is always a big deal, but especially now.
Right, because given the sheer scale of the AI run-up, these pension funds are going to be heavily overweight in equities, specifically tech.
Oh, they will be significantly outside their mandated allocations.
How far outside are we talking?
Well, think about a pension fund operating on a strict 60-40 equity to fixed income ratio. Right now, they are likely sitting at a 70-30 or even higher weighting, purely because of the massive capital appreciation in their tech holdings.
And they can't just leave it like that.
No, they can't.
Okay.
Institutional mandates dictate that they must sell those outperforming assets to buy underperforming ones and restore the required balance.
So it's totally blind.
Exactly. This is a blind, mechanical liquidation. It is completely agnostic to the fundamentals of the companies involved. And because AI and semiconductors have experienced the most aggressive appreciation, they will naturally be the primary targets of that forced selling.
That makes sense. And right on the heels of that U.S. rebalance, the second week of July brings the settlements for Japanese index-linked exchange-traded funds.
Yes, the ETF dividend-related selling. This is a huge domestic event.
The outlook estimates a staggering 1.7 trillion yen in dividend-related selling expected, but I have to push back on the impact of this for a second.
Sure, go ahead.
When we look at the daily trading volume in these semiconductor names right now, it's astronomical. I mean, can a 1.7 trillion yen forced liquidation actually derail this momentum? Or is the market currently deep enough to just absorb that as a temporary speed bump?
That's the trillion yen question, literally. It is a question of liquidity absorption at peak valuations.
Okay, break that down for us.
Yes, daily volume is massive right now. But the 1.7 trillion yen outflow represents concentrated, unidirectional selling pressure. And it's hitting the market exactly when valuations are stretched to historical extremes.
So there's no margin for error.
Exactly. If that mechanical selling aligns with even a minor shift in retail sentiment, or just a slight hesitation in those passive inflows we discussed earlier, it essentially removes the floor.
Wow.
A structural sell-off doesn't necessarily have to break the market. It just has to exhaust the incoming capital long enough to trigger a cascade of profit-taking from those who have been riding the 10x wave.
It essentially acts as an invisible ceiling on the current rally.
That's a great way to put it.
But, we can't just look at domestic equity flows in a vacuum because the macro data in this outlook presents a completely separate set of headwinds, particularly regarding global interest rate policies.
Right. The macro environment is honestly pretty hostile to this kind of rally right now.
Exactly. The Bank of Japan decided on a rate hike recently, which inherently compresses valuations for high-growth sectors. But the detail that really stands out in the report is that the decision wasn't unanimous.
No, it wasn't. Board member Toyoki Asada formally opposed the hike.
Which is huge. What did the market do with that information?
Well, Asada's dissent is a critical piece of data because it reveals internal friction regarding the terminal rate. The market immediately priced in a slightly dovish interpretation of that dissent.
Basically assuming the BOJ might be more hesitant to aggressively tighten moving forward.
Right, exactly. However, any dovish relief generated by the BOJ was immediately counteracted by the data coming out of the U.S. Federal Reserve.
Right. The FOMC held rates steady, but the dot plot, the individual rate projections of the Fed members, tells a very different story.
A very hawkish story.
Yeah, 9 out of the 18 members explicitly hinted at a rate hike later this year. Plus, you add to that the statement from U.S. President Trump indicating he will respect the Fed's independence.
Which is a major political green light.
Exactly. You have a scenario where the Fed has the unencumbered political runway to maintain higher for longer policies, or even actively hike if inflation proves sticky.
And we need to talk about why that matters so much. The interaction between the BOJ's internal hesitation and the Fed's hawkish posturing directly impacts the cost of capital.
Which is terrible for tech.
It is the absolute kryptonite for a momentum-driven tech rally. Growth stocks, particularly in the AI sector, are valued on future cash flows extending years or decades into the future.
Right. They aren't valued on what they make today.
Exactly. So when global discount rates rise, the mathematical present value of those distant profits shrinks exponentially. Institutional investors look at the risk-free rate available in government bonds, and they readjust the multiples they are willing to pay for Kioxia today.
So the math just stops working.
Right. Hawkish macro data doesn't just slow down growth. It actively compresses the valuation math that justifies a 70,000 Nikkei in the first place.
And that brings us to the geopolitical wildcard in the outlook, which honestly I found to be the most counterintuitive data point in the entire report.
Oh, the Middle East development? Yeah, this one throws a lot of people off.
Right. We have a reported ceasefire memo between the U.S. and Iran. Now, on a fundamental human level, a ceasefire in the Middle East is an unambiguous positive.
Of course.
Mhm.
And usually the market loves that kind of stability.
Right. In a traditional market environment, a reduction in geopolitical risk usually lowers the equity risk premium across the board. Shouldn't peace in the Middle East be good for all stocks?
You would think so. But it's actually a classic example of how macroeconomic shifts trigger brutal sector rotations.
Okay, how so? Explain the market reality here because it feels totally backward.
Well, look at the immediate mechanical consequence of a U.S.-Iran ceasefire. It means a stabilization of global shipping lanes and a sharp, sudden drop in global energy and raw material costs.
Okay, lower oil prices.
Right. And over the past year, high input costs have severely suppressed the margins of traditional manufacturing, heavy industry, and utility sectors.
Which is the core of the value stock universe.
Exactly. Meanwhile, software and semiconductor design companies have been largely immune to the cost of crude oil. That immunity allowed growth stocks to thrive in a high inflation environment while everyone else struggled.
Oh, I see. So if peace breaks out and crude oil plummets, the cost structures for those traditional manufacturing companies just collapse overnight.
Yes, their project margins instantly expand without them having to sell a single extra product.
Wow. And institutional portfolio managers are ruthlessly pragmatic about this stuff.
Extremely ruthless. They look at a landscape where they are currently paying astronomical, historically stretched multiples for AI stocks.
And then they see traditional dividend-paying value stocks suddenly looking at explosive earnings growth due to collapsing energy costs.
Precisely. The ceasefire actually becomes the fundamental catalyst for capital flight. The smart money begins systematically liquidating their overvalued growth positions to aggressively accumulate undervalued manufacturing names before that margin expansion is fully priced in.
Which brings us right back to the capital starvation issue we talked about earlier.
It all connects.
If institutional money rotates heavily out of growth and into value, they are essentially pulling the engine out of the Nikkei.
Because the index is sitting at 70,000 almost entirely because of Kioxia and semiconductors.
Right. If a drop in oil prices makes Toyota or Mitsubishi Heavy Industries look like better investments, the capital flowing into those traditional names won't be anywhere near enough to offset the massive market cap damage caused by selling off the tech giants.
Exactly. It really highlights the vulnerability of a concentrated market. A positive geopolitical event that benefits the broader real economy can simultaneously cripple a top-heavy stock index.
That divergence between the real economy and the equity index is just fascinating. And, this interplay between U.S. and Japanese rate environments naturally forces us to look at the foreign exchange data.
Oh yeah, the currency tightrope. It's incredibly tense right now.
The outlook data on the yen paints a picture of extreme paralyzed tension. The forecast range for the USD-JPY pair is firmly set between 158.00 and 162.5 yen.
And the volatility within that narrow band is intense. The outlook specifically highlights the movement on June 18th, where the yen depreciated to 161.82.
Dangerously close to the edge.
Very. That level is mathematically critical because it sits directly adjacent to the previous intervention highs we saw back in July 2024.
Oh, the market definitely remembers that.
Exactly. The market memory of that intervention is still dictating trading behavior today.
The drama there is incredible. The psychological aspect of that is huge. The report actually notes that the moment the pair hit 161.82, there was an instantaneous 80-cent drop.
And the crazy part is, the Ministry of Finance didn't even do anything.
Right. They didn't actually deploy any capital. They didn't have to formally intervene. The sheer fear of a government intervention, just the mere proximity to the theoretical line, caused a panic sell-off of dollars.
It's a phantom intervention.
The government is essentially utilizing the market's own anxiety to enforce a ceiling without having to spend a single dime of foreign reserves.
It is a highly effective, albeit temporary, strategy. It's basically verbal and psychological yield curve control. Traders are aggressively testing the boundaries, trying to map the exact coordinates of the government's pain threshold.
But they're terrified of going too far.
Exactly. The fear of being caught on the wrong side of a massive, unannounced dollar dump forces them to self-regulate at the extremes.
And what about the floor?
The data also provides a floor. The 25-day moving average is acting as firm technical support right around the 158.000 yen mark.
So we're just stuck in this violent, compressed channel.
Right, ping-ponging between the technical floor of 158 and the psychological intervention threat ceiling just above 162.
So if we look at the big picture here, we have an index at 70,000, hoisted up by an AI momentum trade that is actively starving the rest of the market of capital.
Right.
We have 1.7 trillion yen in mechanical ETF selling approaching, hawkish Fed dots threatening tech multiples, a potential geopolitical shift favoring value over growth, and a currency market trapped in a volatile pressure cooker.
It's a lot to navigate.
It really is. So with the market hanging in this delicate balance, what specific official figures from the outlet do you, as a viewer, need to watch in the coming week? Let's group the official figures by the specific stress points they are going to test.
Let's start with the data that will directly test the AI and growth narrative. The most critical litmus test for the tech narrative this week will happen on Wednesday after the U.S. market closes.
Micron Technology earnings.
Exactly. Micron is a fundamental bellwether for the entire memory chip sector.
Because if Micron reports a slowdown in enterprise demand or even just issues weak forward guidance, the multiples currently being applied to Kioxia become mathematically unjustifiable.
Completely. The entire premise holding up the 70,000 Nikkei relies on endless semiconductor demand.
And if that cracks?
The reaction in Japanese tech stocks will be instantaneous the following morning. We also need to look at Tuesday's data. Japan releases the S&P Global Manufacturing PMI, and we have the IPO for Nikkei.
But the U.S. data that day is equally vital, right?
Yeah, very much so. We get the U.S. manufacturing PMIs and FedEx earnings.
Why FedEx specifically?
Because FedEx provides the most accurate, real-time read on global shipping and enterprise logistics. Long before government agencies compile their broader economic data, FedEx volume tells us if the real-world demand for physical goods is expanding or contracting.
Which feeds directly into our second major theme for the week, the macro and inflation reality check. We have crucial data testing whether the BOJ and the Fed have the runway to maintain their current policies.
Right. Monday sets the tone with China's loan prime rate, setting the baseline for Asian liquidity. But Wednesday is the real pivot point in Japan.
With the services Producer Price Index and the BOJ's Summary of Opinions.
Yes. The Summary of Opinions will be heavily scrutinized, specifically to isolate board member Asada's rationale.
The market needs to understand the exact economic metrics that triggered his dissent on the rate hike, right?
Precisely. If his reasoning points to a fundamental weakness in domestic consumption, it drastically shifts the probability of future BOJ action. We will also see a 5-year Japanese government bond auction on Tuesday.
Let's drill into that for a second. Why is the 5-year JGB auction such a vital metric right now, particularly following a divided BOJ decision? Why not the 10-year?
Well, the 5-year auction serves as the ultimate test of market conviction regarding the BOJ's path. Short-term yields are anchored by immediate policy, and 10 to 30-year yields reflect long-term demographic and inflation trends.
So the 5-year sits right in the middle.
Exactly. It reflects the market's expectation of the central bank's tightening cycle over the medium term. If the auction sees poor demand, driving yields up, it means institutional investors are rejecting the dovish interpretation of Asada's dissent.
They'd be betting the BOJ will be forced to hike aggressively to defend the yen.
Right. But if demand is strong, it means the market believes the BOJ is done tightening.
That is an incredibly elegant way to read the bond market's reaction to central bank politics.
It's a great real-time indicator.
And finally, the inflation data hits at the end of the week. On Thursday, Japan releases department store sales, giving a read on domestic consumer strength. And the U.S. drops a massive slate of data.
Yeah, Thursday is huge in the U.S. Personal income and spending, durable goods orders, final Q1 GDP, and crucially, the PCE deflator.
The PCE deflator being the explicit inflation gauge the Federal Reserve utilizes for their policy decisions.
Right. That single number will dictate the validity of the FOMC dot plot we discussed earlier.
And then on Friday, Japan releases the Tokyo Consumer Price Index,
which operates as the leading indicator for nationwide Japanese inflation. And notably, Friday also marks the peak day for corporate shareholder meetings across Japan.
Oh, right, where management teams will have to publicly address capital allocation strategies in the face of this increasingly hawkish environment.
Exactly, they won't be able to hide.
The confluence of data dropping this week is just extraordinary. Let's briefly consolidate the core architecture of the market we've discussed today.
It's a lot to process.
It is. The Japan Weekly Outlook presents a Nikkei 225 that has achieved a historic milestone, breaking 71,000. But analyzing the raw data reveals that this altitude is being maintained by a singular, incredibly powerful engine, Kioxia and the semiconductor sector.
Yes, very concentrated.
That engine is currently absorbing massive overheated valuations through relentless passive and momentum buying while simultaneously starving traditional Japanese sectors of capital.
And this narrow foundation is heading straight into a gauntlet.
Exactly. 1.7 trillion yen in mechanical ETF liquidations, rising global discount rates compressing tech multiples, and a paralyzing fear of currency intervention at the 162 line.
It is a delicate, highly concentrated structure navigating an increasingly hostile macroeconomic environment. And, if we synthesize the geopolitical data with the equity flows, it leaves us with a fundamental structural question to evaluate as this week's data rolls in.
I agree. What should the listener be pondering this week?
Well, we discussed how a de-escalation in the Middle East, such as that U.S.-Iran ceasefire memo, could collapse energy costs, radically expanding the profit margins of traditional beaten-down manufacturing companies.
Right.
This creates the perfect catalyst for a massive rotation of institutional capital out of highly valued growth in AI stocks and into undervalued value stocks.
The great unwinding of the momentum trade.
Exactly. So the analytical question you need to focus on is this. If that predicted shift from growth to value stocks actually happens, if the capital that has been exclusively chasing Kioxia and the semiconductor giants begins to flow back to the broader, traditional Japanese economy, is that traditional sector strong enough to support a 70,000-point Nikkei on its own?
That's a scary thought.
Or will we discover that the 70,000 level was never a reflection of the Japanese economy at all, but simply a temporary monument to an AI momentum loop that finally ran out of capital?
That is the definitive structural question underlying everything in this outlook. We are watching a market completely dependent on a handful of giants, practically daring the macro environment to try and knock them down.
It's going to be an intense week in data, that's for sure.
Absolutely. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.